Okay, guys. So my name is Diego. I work at Gradient, and it's essentially. So I'm gonna be going over a weird rant about NFT lending. So, basically, Gradient is our little project, and we're trying to think about, NFT lending is a very tough problem. Just lending in crypto, it's very weird. My presentation is I'm essentially gonna be walking you guys through kind of an alternative way of thinking about lending and how we can solve, how we can circumvent many of the things that are the reason why, I cannot get money for my apes. So, basically, but let's just begin thinking about lending in crypto. Okay, yeah, so lending in crypto has this thing which is completely, obviously, completely permissionless, which is a little tough because, the fact that it's permissionless means that we cannot gatekeep. We cannot be, I'm not going to give this guy a loan. In principle, I should try to give everyone, I have to take credit. I have to be able to deal with all forms of credit risk, which is, not a thing that we see in traditional markets. Because in traditional markets, you just got to submit, and it leads to the next slide. Yeah, so lending in crypto has, no KYC, right? So I have no idea, somebody wants to take out a loan, and I have no clue. It's very, say somebody wants to take out a loan, and it's a new wallet. It's just a recently funded wallet, so it's impossible very often for me to know whether a given borrower is going to default on their loan. And so, the next part is that, we cannot hold them liable either. If the guy defaults, I cannot go get him. I cannot sue him, or I cannot really do anything about it. And so this creates a very tough scenario because at least in traditional markets, for non-recourse loans, non-recourse loans are the kind of loan where just in traditional finance, it's like secured loans where, if the guy defaults, you liquidate the collateral. And that's like mortgages, for example. But at least in those cases, banks are very careful to whom they give out a loan, the size, and it's a very different scenario. So what that means that in crypto, that kind of works for, for fungible lending for very liquid assets. For example, in the case of Aave, we have, given borrower deposits a collateral belonging to a very particular kind of, list of allowed assets, and they get a loan, back. But that's tricky because the reason why that works is because Aave can kind of know that obviously there are many reasons why that makes sense. And the key reason is that at least Aave knows the price of the collateral. So they can know, what kind of, what size of the loan to give. And they know that, if the guy defaults, they can sell the collateral for at least the size of the loan. So that's very cool, if you know the price. But the question is, what about illiquid assets? What about assets about which you have no idea about the price? I make a one of one. I don't even know the price myself, right? It just presents a new category of problem because, obviously, you could try to use, for example, TWAPs, try to find the average floor price in a collection. But again, the more illiquid it is, the trickier it becomes because, it goes back to this question, which is, so this is assuming, the same model as Aave, the guy deposits an NFT and they get a loan back. But the problem with that approach is that somebody may end up holding the bag. And what that means is, we have a loan, and the size of the loan is, what we appraise the NFT is worth, could be just any number. An LTV, which is the loan to value, it's how much of the value of the collateral we're willing to give out as a loan. It could be 30%. That's what, some NFT lending protocols are attempting to do. But then the problem is, when the guy defaults, if they default, they gotta sell the collateral, and they may sell it for an amount less than the size of the loan. So we run into something called deficiency balance. And a deficiency balance is how much money the protocol is losing after selling the collateral. So again, the tricky thing about this is that with illiquid assets, we have a risk of deficiency balance. Aave, they have 80%, they only give, for example, you deposit an ETH, and you only get a loan of 80% that value, because they're like, damn, maybe the price of ETH is going to drop, and I need to be able to sell the collateral at a discount. But again, for NFTs, illiquid assets, the way we've been thinking about lending so far does not seem to fully extrapolate. And so that's kind of got us thinking about what are some other different ways that other different approaches that not necessarily rely on pricing things. Because the question, what's so tricky about this is that if you try to price things, you always end up in square one. Who knows the price of an NFT? It's very hard, unless you sell it. Like, it's very hard to predict the price, right? So what I'm thinking is, what if, like, I'm going to give you guys an example. What kind of triggered our thing into existence is this other protocol called Abacus. What Abacus did is, they were essentially appraising NFTs in real time, but the way they did it was people would speculate on the price of the NFT, and they would make a bet. They would stake ETH. They would stake money. And then the lending protocol, could choose to give out a loan, say, let's choose, let's just say, for example, a punk. The borrower gives us the punk. We open up a pool in spot, and people add liquidity to the pool. And they can see, oh, is the liquidity in the pool more or above what I think is the price of the NFT? And so what that means is, like, people essentially make bets, and then if the guy defaults, what the lending protocol does is it taps, like, it extracts, it sells, we give the NFT to Abacus, and Abacus gives us the money in the pool. And what that means is, like, we're guaranteed that in the event of a default, we're going to get the same amount of money we lent out. And that solves the problem. Like, that solves the problem of, that solves the problem of deficiency balance. Because, like, what Abacus did was, like, essentially guaranteeing that we're going to get the same money that we lent out if the guy defaults. So Abacus, at the core, acts as a credit default swap. A credit default swap is a credit derivative. And that's a very big thing, like, just in existing, financial markets. Credit derivatives are a key tool that lenders use to first of all, isolate the risk and shift it. And that's very interesting because, at the core, it's a different way of thinking about lending in crypto. It's this idea that, you can shift the risk to a speculator who's willing to take it at their discretion for money, right? We offer them a premium for buying, for taking a risk. We offer them a premium, and if the guy defaults, they're willing to take the L for us, right? And so, we kind of began thinking a lot about that direction, and we were thinking, what if, like, we just double down on this idea? Because at the end, what Gradient, what the lending protocol would do is, somebody wants to take out a loan, and we shift the risk to the market. That's essentially what we're trying to do here. Like, the lending protocol has no exposure to the risk. The risk is shifted to the market, to speculators. And so I'm going to walk you guys through kind of, how that kind of looks like. So say, we have, again, a punk. And somebody wants to take out a loan of 10 ETH. Let's assume for simplicity that we know that this punk, we know for a fact in this example that this punk is worth at least 8 ETH. So what that means is, if the guy defaults, we gotta go, now we're going to the market and we're like, all right, we gotta sell the punk and try to get the money back. And we know that we're gonna get at least 8 ETH. But the problem is, what's gonna happen to these 2 ETH up here? What's gonna happen to, so we have the NFT is gonna sell for, we have, like, the loan, if we divide it into parts, it's covered from 0 to 8. But what's gonna happen to, like, the 2 ETH that go, from 8 to 10, right? We have what would be, like the protocol would be exposed to, like, not getting those 2 ETH back. So what we could do is, we could give a chance for somebody to try to speculate on the price of the NFT. We can be like, somebody maybe, I think, this alien, is worth quite a bit of money, and I'll be willing to, stake 2 ETH. I'm gonna give you 2 ETH, and, if your borrower defaults and I gotta go sell your NFT, and your NFT sells for less than 10 ETH, I'm gonna give you the 2 ETH. So you're not gonna lose any money. In exchange, they're gonna ask for a fee. They're gonna ask for what's known as a premium. But what's interesting about this is that we essentially shifted the risk of this part of the loan. We shifted the risk from us to a speculator. And then what we could do is we pass the money that the guy is asking us for buying the risk, we pass it to the borrower as the interest rate. And so that essentially creates a system where, and I'm going to walk you guys, like, it's going to be simpler in a couple of slides. But, what's interesting about this is that, before, we had the full loan, and then post-default, say this money, we get it back from selling the NFT. but maybe this money we're not going to get it back because like the NFT does not sell for sells for less than the size of the loan. But now we have this thing which is like we have insurance. We essentially have insurance on this part of the loan. And what the guy did was not try to speculate on whether this borrower is going to default. They're not trying to speculate on the price of the NFT. What they're actually doing is, it's this idea we could buy insurance for the NFT selling for less than the size of the loan. And the reason why that works is, whoops, oh damn. Yeah, so the reason why that makes sense is that we're not, it's very hard for speculators to try to speculate whether a new wallet, an anonymous wallet will default. It's very hard to know the price of things. What I'm trying to say is like you don't have to do that. What you have to do is like you try to speculate on whether an NFT is worth more or less than a given price. I can speculate whether a punk is worth more than 1 ETH. I don't know how much it's worth. It doesn't matter. Like what actually matters is our ability to get insurance on parts of the loan. And so yeah, that's kind of the way we've been thinking about lending. And I have a few diagrams that should make it easier. Do you guys have any questions so far? Yes.
How do you appraise different trades of NFTs? Because different NFTs based on their trade.
We don't do it. We don't appraise. That's the key part. Like, what's interesting. Okay. Do you want to repeat the question?
How do you appraise the different NFTs?
Yeah. So what's fascinating is that like what I'm essentially proposing is a way of circumventing appraising. Like you don't actually have to appraise things. Like what you essentially do is you create a way for the market. You allow speculators to have exposure at different parts of the price line of the collateral. And people, you let market participants do it. Like it could be a guy, they may have like an AI model. They could use TWAPs. They could use whichever strategy they want. And I'm going to give you an example in just a sec. So yeah, so like the idea is that we can like again, right before we were giving the example of like securing a part of the loan, from like the top to ETH, but like the truth is, we can extend that for the entirety of the loan. So essentially get full insurance on the loan. And what that means is we have protection for the NFT, even if the NFT sells at zero, the protocol cannot incur loss. Because this is just held by speculators, right? Somebody gives insurance on this part of the loan, somebody gives insurance on this part of the loan, on this part of the loan, on this part of the loan, and so on. And yeah, like it's this idea that it's more realistic to speculate if an NFT is worth more than X. It's more realistic to speculate whether a punk is worth more than 1 ETH or 2 ETH or 3 ETH than whether it is exactly worth 100 ETH or if a given borrower will default. It's a different form of, it's essentially this idea of shifting the risk, but it's different than TradFi in that in TradFi like CDS are built for like obviously under collateralized lending. In this case, it's essentially you could think of it as like insurance on different parts of the price line of the collateral. And obviously as you go farther up the price line, this tranche, because like these are essentially tranches, right? This tranche is going to be riskier because obviously it's way riskier. This guy is going to be, I'm going to give you 1 ETH if the NFT sells for less than 10 ETH, whereas this guy is going to be, I'm going to give you 1 ETH if the NFT sells for less than 1 ETH. So this has a much lower probability. This insurance has a much lower probability of being triggered. And at the same time, all of them together, they provide insurance for a loan of 10 ETH. And so every tranche has a different risk, and what that means, and so like now, yes? Yeah. So the idea, the next question is exactly that one. How do you incentivize people to sell you insurance? That's a question. Let's rewind a little. So far, we've got into a way of shifting risk, and so now the question is, how do we incentivize buyers of this risk? Or in other words, you could think of it, how do we incentivize sellers of of insurance on every tranche? So the way you could do that, first of all, let's think about that problem. So what we essentially do is, we get, okay, some guys like, okay, I'll give you this ETH if when you liquidate your NFT, it sells for less than 1 ETH, and we have to pay them. We have to pay them a fee. So now the question is, what's the least premium, what's the least fee that will get us somebody to sell us that insurance? The idea is that, if you put the premium, if you offer a premium of 3 trillion APY, like I'm gonna sell you the insurance myself. There's a point where, it's a question of finding, like if you let the insurance go from 0 all the way to infinity, chances are, you're gonna be able to find, it's a question of, now the question is for the right premium, this is an assumption, obviously, like there's, obviously economic evidence of like this not exactly being like this, but the idea that like, if you offer a high enough premium, there may be a buyer willing to buy that risk. Again, if you offer, a quadrillion APY, like I'm sure that like there's going to be like different parts of the loan, they're like if you let the premium float, it's eventually going to match what would be the risk-reward ratio of a given seller. And so the way you do that is like, it gets a little more technical, but there's something really interesting, which is reverse Dutch auctions, which is, you essentially let the premium, you offer to buy insurance at increasing premium. So you're like, okay, I'm going to buy, for example, I'm going to buy insurance on this tranche, and I'm going to pay at most 0.1 ETH. Or like I'm going to pay at most, I don't know, 2% APY. And then you raise it all the way to infinity until somebody is willing to sell us insurance for that APY. What that means is you essentially allow price discovery on the premium. And the reason why that makes sense is because we made the assumption that if we let the APY go all the way to infinity, eventually, there's going to be somebody who's willing to sell it for us. And so now, essentially, what we do is like, we can, we can use something called, reverse gradual Dutch auctions, which is essentially getting, a ton of reverse Dutch auctions here. So we essentially find the premium for every tranche, and then what we do is this premium we collect it, and then we pass it as the interest rate for the borrower. And what that essentially means is, the borrower is essentially paying for, how much it takes to shift the risk to speculators. And so yeah, basically, I'm gonna get into those other slides in just a sec. Do you guys have any questions so far? Yes.
Thank you for the presentation. So I just summarized my understanding, if it's correctly, and actually I have 2 questions very shortly. So basically, the project is like on the borrower side and the lender side, that you're switching the risk from the borrower to the speculator who in the market. And from the borrower side, you charge the interest rate that to paying the premium, right?
Yeah.
So then the user cases from borrower side, is that going to be a fixed interest rate, or how do they expect the interest rate?
That's a great question. So, okay, so let's think about how the model would work like. So somebody has an NFT, they want to use it as a collateral, and they specify the size of the loan they want to take and a maturity. Let's just say it's, I don't know, a week, right? And so, the borrower deposits their NFT, and what the lending protocol does, it essentially fractionalizes the debt, and we incentivize sell-side liquidity on the insurance for every part of the loan. We incentivize sell-side liquidity on insurance across the whole loan. And so, people are, the way we do that, we get to that, we allow that price discovery using reverse Dutch auctions, and then, the premium that would get, the total premium that would get insurance on the whole loan, we pass it to the borrower. The borrower obviously, would get to, obviously they would not, they would have the option to accept. But the question is, the key idea here is that the lending protocol can only loan as much as it can get in insurance. And the way we incentivize insurance is through the interest rate that the borrower gets to pay. And with this idea, what you essentially do is you find the least interest rate, you find the least premium that incentivizes enough insurance for the protocol to not be left holding the bag. You incentivize enough insurance for the protocol to not end up with a potential loss should the borrower default. Yeah. Do you have a second question, or?
Yeah, actually, you have already answered the second question. So I think it's very smart because you let everything to the market decide.
Exactly.
And
You
yeah.
outsource. You can think of it as outsourcing the decision making. You know, I am no one to. I don't have to appraise things. Like the whole point is removing the need. Like the whole idea is letting the market make all the hard choices. That's the bottom. You know, I'm a procrastinator. I have serious problems with procrastinating. I like this idea of like, you know, just letting things resolve themselves, which is probably a bad choice like in a just normal life. But here it kind of works out because you solve many of the problems that we've seen so far, which is you solve the problem of like not knowing the price, you solve the problem of illiquidity, and above all, you forget about the issue of the protocol being left holding back. And you can extrapolate this like any form of peer-to-peer lending, NFTFi or like any other, just lender-borrower relationship. Yeah. Thank you. Yes.
So, outside, like there's two things I think you're shifting over to the speculator. The risk, but as well the need to appraise. So somebody still needs to appraise because I still need to kind of have a layer over there, which is, by the way, I feel much more complex to price because I'm sitting somewhere in a block, in a certain layer. So how would the market or the speculators appraise then? Or is it just like a fractionalization of appraisal?
Yeah. Well,
as it is with risk? That's
a good question. It goes back to like, what essentially happens is, people can see, there's a loan, which is, they could use limit orders. There are many ways that these could be optimized, but, let's just keep it really simple. You can see, oh, somebody wants to take out a loan of X size, and we have the chance of like selling insurance on, for example, the punk selling for less than 1 ETH. So what you do is, I would be willing to sell insurance for that tranche myself, because like I know for a fact that like punks don't sell for less than 1 ETH. You let the market. What you do is, people can use any tools they want. They could use Upshot, they could use NFT Bank, they could like think about the trades, and the idea is like, and you don't have to like, gain exposure to like the higher, the most riskier tranches. Like again, for example, I'd be willing to like sell insurance on the punk selling for less than 10 ETH. It's the idea that you don't have to know the exact price. What you need to do is like, you need to understand how much premium, how much risk you think is that the NFT sells for less than that, and then how much money you want to get for taking that risk. What is the amount of money you're willing to take? And so, it goes back to the questions of like, how do people price, credit default swaps in the real world? It's a different thing, but the idea is that, the ways you come about like pricing premiums or spreads, I think there are ways in which we can outsource it to, there's no need for the protocol to do that. Like I think the play is like in just creating structures and efficient structures and just letting, agents do their thing. Yep. Do you guys have any other questions?
Do you see like a scenario, let's say we have a really bad downtrend in the market and the risk appetite of these risk takers decreases in a substantial way? Do you see any scenario where, I wouldn't call it collapse, but where people are not interested in taking that risk anymore and you kind of have to have super high premiums for them to take that risk?
For sure, yeah, that's very realistic. That's probably what would happen actually. It's a risk, like what you're gonna see is certainly, obviously the baseline across every tranche would increase, but again, chances are, what's interesting is, what volatility has on the effect that volatility has, on the premium across the tranches. Obviously, volatility means that, the upper tranches are riskier. And, it goes back to the question of, what if like, what if just the risk increases a lot, just over the table, just along the table. And premiums are gonna be higher. And like, it's just, it's the price of the risk. You could think of it that way. The way I think it is like, it's probably very reductionist, but like it goes down to the idea that, the risk the speculator is not buying is being kept by the protocol. And, to what extent does it make sense for the protocol to like subsidize or like, just get that just retain that exposure. Obviously, like in the future, what's really, interesting extension of this idea is that you can go well beyond the JPEGs and you can start collateralizing, for example, bonds. You can collateralize, like something fascinating is the idea that you can tokenize physical assets and potentially get a loan on tokenized physical assets with this. And I could put this loan on Yearn and get yield. What makes me the most excited about this is that at the core, with this ability of universal underwriting, you remove any boundaries in the way we've been thinking about collateral. It's the idea that people like to say the financialization of NFTs. I would rather say it's the financialization of everything. Obviously, the question is how do you scale this system? And you start tapping into what if you under collateralize the insurance? Probably it's going to act in an OTC manner, over the counter. There's a lot of nuance that goes into building the system like this, and those details are a bit of outside of the scope of this primer. But I guess my key takeaway for you guys is I think there's some other ways of thinking about we think because we've been working on this for some time now and doing simulations and so on. There's some other ways in which we can think about lending, and one of them is this one. And so with this one, we think that perhaps NFT lending in 5 years is not going to run on this, but we think that I would be surprised if we were directionally wrong. So yeah, so welcome to the gradient, guys.